Work until your money works for you. In 2025, nothing symbolizes that financial independence quite like a well-built dividend ETF portfolio. These are the reliable, cash-generating machines that quietly compound wealth and keep those monthly or quarterly deposits flowing into the bank. Not all dividend ETFs are created equal. Some are built for growth, others for yield. A rare few strike a balance, offering solid returns and consistency. In this mid-year showdown, it's time to pit the top dividend ETFs against each other. No fluff or fancy animations, just real metrics. We'll provide a full picture of what's been winning in 2025 and what still has legs to run. First up, SCHD, a fan favorite, and for good reason. Short-term performance hasn't been its strong suit lately. In a head-to-head battle, SCHD came in second place behind DIV for the year. But when the zoom lens pulls back, SCHD starts to shine brighter. Over a 3-year span, SCHD logged in a 10% total return. While it looks modest next to some growth-tilted peers like DGRO and VIG. Push the horizon to 5 years, and the story starts to flip. SCHD posts a 76% total return, closing the gap with heavy hitters. SCHD delivered a 170% return over 10 years, ranking 4th among ETFs that have existed for at least 10 years. CHD holds the #1 spot for dividend growth, with a 10-year CAGR that outpaces even aristocrat-focused ETFs. The trailing 12-month dividend yield is 4.17%, just behind FDL, ranking comfortably in second place. Combining growth and yield, SCHD rules with a high rank across all categories, consistently dominating the podium. Next up is DGRO, known for its calm demeanor but powerful underlying performance. In the past 3 years, DGRO delivered a 28% return, outperforming SCHD and even the popular DIV. Extending to 5 years, DGRO tied with VM at an 86% return, surpassing SCHD's 76%. In 10 years, DGRO stands at a striking 191%, just behind VIG's 192%. What really elevates DGRO is its ability to combine price appreciation with consistent income growth. It shows a 10-year dividend CAGR of 9%. DGRO has a solid trailing yield. It lacks upfront yield, but compensates with long-term growth and compounding strength. DGRO's biggest advantage: balance. It offers equity-like upside with a dividend growth tilt, ideal for steady wealth growth. Introducing VIG. It doesn't grab headlines, but excels in consistency, often outperforming competitors over various timelines. VIG achieved a 192% return over 10 years. Its yield is modest at 1.82%, focusing on capital preservation and steady compounding. With a 7.5% CAGR on its dividends, VIG appeals to those valuing long-term preservation and low volatility. VIG only holds companies that have a record of growing dividends for over 10 years, ensuring quality investments. That quality filter keeps many high-risk names out of the fund, making VIG a more conservative bet in uncertain times. VIG's sector balance leans towards industrials, healthcare, and consumer staples, reducing exposure to volatile sectors like tech. Despite its modest yield, consistent dividend growth helps investors build serious income over time through reinvestment. It's backed by Vanguard, a firm known for low expenses, boosting long-term returns through fee efficiency. VIG attracts long-term investors, those building for retirement or passing wealth down to the next generation. This ETF may not be the flashiest, but it delivers disciplined growth, solid companies, and historical reliability. In turbulent times, VIG's stability is a trait seasoned investors prefer. FDL may not get as much press as SCHD or VIG, but it deserves attention when discussing current income. Let's discuss yield. 4.17% trailing 12-month dividend yield, the highest in the lineup. In performance, FDL delivered a 37% total return over 3 years, outpacing DGRO and VIG. Over 5 years, FDL racked up 119% in returns, just behind the international leader, VMI. In the 10-year stretch, FDL holds its ground with a 156% return, narrowly missing SCHD. FDL's 7.7% CAGR for dividend growth is solid, but not elite. Still, it prioritizes immediate yield. This ETF is tailor-made for income-focused investors who value dividends above all. It boasts a strong presence across the financial and utility sectors. FDL consistently delivers income during turbulent markets without heavily relying on tech or high-growth sectors. FDL's strategy focuses on reliable companies with long histories of paying dividends, many staples of the American economy. FDL's quarterly payouts make it a favorite among retirees and those supplementing monthly income without major volatility. Despite being conservative, FDL shows surprising capital appreciation strength when markets rebound, offering a two-pronged value proposition. DIV is an underdog ETF, making waves by beating competitors like SCHD recently, showing impressive returns and emerging as a genuine competitor. With a 31% return over 3 years and 100% over 5 years, DIV is no longer just an alternative. Its performance indicates it could be a serious player. As a high-yield fund, DIV focuses on payout-heavy sectors. This brings both risk and reward, with price performance that can be volatile. For those looking to diversify their income ETF mix, DIV brings a unique angle to the table. One standout feature is DIV's focus on international and domestic companies with high dividend yields. It includes smaller and mid-sized companies that traditional ETFs might overlook, adding potential to its portfolio. With a trailing 12-month dividend yield among the highest, it attracts those seeking strong monthly income streams. Despite its volatility, DIV's high payout can act as a buffer in sideways or bearish markets. Now, let's talk about DLN, a wisdom tree ETF that has emerged with surprising strength. DLN returned 180% across the 10-year track, placing it just ahead of SCHD and below DGRO and VIG. DLN's dividend growth is at 6.6%, with a current yield of 3.2%, appealing for steady income with upside potential. It's well diversified, making it resilient during drawdowns and smooth in sideways markets. Among newer competitors, DLN fits neatly into a modern dividend portfolio aiming for cash flow and growth. VM has consistently surprised investors. Without much fanfare, it has quietly crushed expectations over several timeframes. In the 3-year stretch, VM returned a strong 26% and over 5 years posted 86%, tying with DGRO and VIG. Zooming out to 10 years, VM returned a rock-solid 150%, keeping pace with SCHD and outperforming Noble and DVY. VM ranks solidly in yield, dependable but not the highest yield or growth. It appeals to those who value long-term consistency. VM tracks the FTSE High Dividend Yield Index, screening for U.S. companies expected to pay above-average dividends. Its holdings include quality blue-chip names like Johnson & Johnson, J.P. Morgan Chase, and Procter & Gamble. VM's expense ratio is just 0.06%, one of the cheapest ways to access high-yield stocks. VM is for those building foundations. It's reliable and might not dazzle, but always delivers. Rounding out the lineup is Noble, the Dividend Aristocrats ETF. It's built from companies with 25-plus years of consecutive dividend increases. Over the 10-year horizon, Noble posted a 143% return, putting it behind SCHD, VM, and others, but shines in dividend reliability. The dividend CAGR of 10% is surprising for many who consider this ETF boring. Yet, it comes with a lower starting yield of around 2.1%. It may not be the top performer in price growth, but promotes peace of mind with its ironclad dividend history. The Aristocrats' approach skews the portfolio toward quality companies that can weather economic storms. With strict eligibility criteria, the ETF prunes companies that can't maintain a 25-year streak, ensuring top-tier growth. It's heavier on consumer staples and industrials, appealing to retirees and cautious investors, although expense ratios are higher. Building wealth doesn't have to be complicated. ETFs can generate income, build legacy wealth, and offer peace of mind through all market seasons. Mid-year 2025 has made one thing clear: consistency beats chaos. Aligning with ETFs that balance return, yield, and growth is key. If this helped you understand the top dividend ETFs for 2025, hit that like button and share your favorite ETF in the comments. Check out one of these videos next to level up your financial freedom journey. Because while money is cool, freedom is better. See you in the next one. Peace. Building wealth doesn't have to be complicated. ETFs can generate income, build legacy wealth, and offer peace of mind through all market seasons. Mid-year 2025 has made one thing clear: consistency beats chaos. Aligning with ETFs that balance return, yield, and growth is key. If this helped you understand the top dividend ETFs for 2025, hit that like button and share your favorite ETF in the comments. Check out one of these videos next to level up your financial freedom journey. Because while money is cool, freedom is better. See you in the next one. Peace.